Hi, welcome to InvestPro. My name is Rain, and today I'm going to share with you one very interesting topic, which is in this video, I'm going to expose one trading strategy or one trading technique which is very popular, widely used by many traders to manage their portfolio, to buy the stocks or to sell their stocks. But unfortunately, this trading technique does not work or is not effective. Or to be more precise, I would say it's not even better than just buy stock at the random time and selling it at the random time. And yes, this strategy called MACD crossover. That is why this video is very important and you need to stay tuned because you want to learn and you want to know how a systematic and professional way to evaluate the effectiveness of one trading technique. And without further ado, let's get started. Welcome back to the InvestPro. So first, I would like to say thank you for watching this channel. And if you are the traders or new in tradings and you want to learn about how to trade or how to possibly profit from the stock market consistently, then I would say you are just in the right channel. But before that, if you haven't subscribed to this channel or you haven't clicked any notifications, then please do it right now because I believe you do not want to miss out any valuable information that potentially makes you become a better traders. And let's move on. Before we deep diving into this MACD and evaluate the effectiveness of this trading technique, we need to understand about how usually professional or traders make use this technique to manage a portfolio, to buy or to sell the stocks. Well, MACD stands for Moving Average Convergence Divergence, but you don't really need to understand what the hell is convergence divergence for now, all right? But you need to know its underlying components. Well, I would say that there are three important components here. First is MACD line, then a second signal line, and also histogram. But for this experiment, for this test, I would say you just need to focus on the first and the second one. It's MACD line and signal line. You can forget about histogram for now. And let me show you on how a trader uses the MACD crossover to buy and to sell stocks. Now, let's take a look on this chart. Well, over here I do have an Apple chart, all right? There is an upper sections and the lower sections. And the upper section, it's clearly, it shows you the Apple, the price bar, right? And the lower part, it shows you the MACD. Well, there are two lines here, all right? The red color and the black color. The black shows it is a MACD line. And the red color represents, I would say this is the signal line, and there's a histogram as well. But as I mentioned to you, you can just forget about the histogram for now. So let's focus on these two lines, the black and the red color. Well, how this MACD crossover works is that when the MACD line, the black color cross over the red color, the signal line, that this indicates bullish in the markets. So some traders, they just want to buy based on this indicator. So when it crosses above the signal line, then it helps them or indicates or telling them it's the time probably to buy because they think that the market is kind of bullish. But when the black color crosses below this red color, it shows bearishness in the market, so probably it's a time to sell. Well, I would say that crossover or cross below, well, we term it as the MACD crossover technique, all right? Now, let me just draw it for you, all right? So this is I would say the crossover, all right? So it's indicate the market is kind of bullish. So sometimes or many times traders start to buy at this point. So they would like to buy at this price. And then when the MACD crosses below the red line, all right, it indicates bearishness in the market, all right? And then it's probably the time for trader to sell. All right. So let me point out a couple of the crossover sign. Okay, you can see clearly this black color cross over the red line. It's a time to buy. All right, I put it bullish. And also over here is kind of bullish. And then over this side is also bullish. So simply that when the black color, the black lines crosses above the red color, it's a show bullishness in the markets, and traders like to buy when the market is bullish. And then when the market or the black line crosses below the red lines, like over this spot, all right, it crosses below the red line, it indicates bearish, and traders would like to sell. All right, another one at this spot is, you can see the black line crosses below the red line, so it indicates bearishness in the market, and then traders start to sell. So it tally with this price. All right, they start to sell, and over here I would say they would like to buy. Okay, so they buy here, they sell here. All right, over here, I miss out a little bit. All right, but you know, more or less is here. It's they buy at this price. Well, so as simple as that. When the black line it crosses above the red line, it's a time for traders to buy, and when the red line, sorry, the black color line crosses below the red line, then it's a time to sell. So that's how this MACD crossover works, to buy and to sell their stocks. So in order for me to understand about how powerful or how effective this MACD crossover technique, I need to first test how effective the crossover technique to exit the stocks. So then in the first experiments, I need to make a comparison between strategies that comes with the random days exits and the strategy with the MACD crossover exit. But the entry point for these two strategies are the same, which is based on the MACD crossover. That simply means that when the MACD crossover happens, then these two strategies make the entry or buy the stocks. But for one of the strategies, we are using a random time to sell a position. It means that we try to select a multi-exit days to sell off the positions. But for the other one, the other strategy, the entry is using the MACD crossover, and the selling point, the selling time is also using the MACD crossover to sell off their positions. To simulate the random selling days in this experiment, we just limit to 4 different exit days. We are using 10, 20, 30, and 40 days to exit. To make the experiment unbiased, we just run the experiment across the US largest 500 stocks, which is the S&P 500 stocks from January 10 to January 24, which is across 14 years. Now let's take a look on the performance or the outcome from the experiments. Now take a look at this page. Over here, we do have 5 tables, all right, exiting 10 days later, 20, 30, 40 days later, and also we do have exiting by the MACD crossover. Well, you need to understand about how we run this experiment, and let's focus first on the exit 10 days. Well, as I have mentioned earlier, that the entry for this technique is by using the MACD crossover. So when crossover happens, you know, the MACD line cross over the red lines, the signal lines, then we buy the stocks. And then the exit is just take 10 days as a fixed days to exit. Means that, let's say you buy on the day 1, then you sell it 10 days later, which is at the days 11. So if you buy at the day 2, then you will exit 10 days later at the day 12 or something like that, all right? So this is the result when you are using the MACD crossover to enter to buy the stocks, but you just sell it 10 days later regardless, all right? So you need to look at the average return per transactions here is 0.7%, average winning rate 57.04%, with the total transactions of 68,205. So this happens across 14 years. Well, same thing applies to exiting 20 days later. It means that your entry based on the MACD crossover, and but the difference is that you just hold the stocks for 20 days before you sell it. So if you bought it on the day 1, then you sell it at the day 21. So if you bought it on the day 2, then you sold it at the day 22, basically 20 days later. So this implies, well, it happened the same thing across different exiting days, 30 and 40 as well. So take a look at the 20 days, exiting 20 days later, which the average return per transaction is 1.41%, average winning rate 59%, and total transaction is 68,205. All right. Now, if you compare with a technique using the MACD crossover technique to exit, entry and exit with the MACD crossover, well, you learn that the I would say average return per transaction is 0.84%, but the average winning rate is 40.22%. Well, if I do compare the MACD exit crossover exit technique comparing to exiting 10 days later, well, talking about average return per transactions, the MACD crossover exit technique slightly better, like 0.1 better. But if you compare it, the winning rate here, apparently that when you exit 10 days later, it has a better winning rate compared to the MACD crossover exits. All right, it's 57 over here and 40.22% for MACD crossover. All right, now these two, well, I would say that it's very hard to decide which is the winning technique, I would say. But if you are considering the expected value, means that if you multiply the average return per transaction 0.7 times the winning rate 57, and average return per transaction here 0.8 times 40.22%, then you know the winner is exiting 10 days later because it gains higher expected value. But I would say when you exit 20 days, 30 days, or 40 days later, it's very obvious that exiting 20, 30, or 40 days are the winner here because the average return per transaction is 1.4%, which is exiting with the MACD crossover only 0.84%. So this is almost double, I would say. But the winning rate also kind of the obvious winner over here. And same thing happens for exiting 30 days and 40 days later. If you compare with exiting 40 days later, it's a very obvious winning if you exit 40 days later because the average return per transaction is 2.7%. It's obviously way much higher than the average return per transaction by the MACD crossover. And comparing the winning rate, also this is a big winner here. Now, one trend or pattern that you probably you can identify here is that the longer your exit days, seems that it gives you a better average return per transactions, and also giving you a better winning rate. So excluding this table, if you just look at MACD crossover technique alone, well, your average return per transaction is 0.84% and the winning rate is 40.22%. Well, I would say that it still gives you a slight positive returns, not a big one. All right, but this could, some traders might think, well, it still gives you positive returns because it is a good strategy. Well, I would say that reading this table alone can be very misleading, because when you have more tables for comparisons, you're comparing with assuming like randomly selling them at a random time. I would say that, well, it's kind of obvious the positive returns here, because the US market tend to be bullish, tend to be positive. So not because the MACD crossover exit giving you the edge or advantage as a traders, but that's a behavior, I would say, DNA of the US markets is being bullish, giving you positive returns. That's to be more precise. So the positive returns not because of the technique, I would say, but because of the behavior of the US markets. And from this table itself, it's kind of clear to me that if I use, I exit my positions randomly, it seems it might be better off, especially if I'm exiting 20 days and above. So randomly, or in general, when I exit without the MACD crossover, but I just choose one random date, maybe 21 days or it can be 30 days. Well, generally or statistically, I would say it would be, or I will gain a better exit or better returns, both from the average return per transactions or the chance to win. It's going to be higher. So I don't think from the exit itself, the MACD crossover has shown you or demonstrated the advantage or the edge for traders to exit their stocks. But then some of the traders might argue that, well, MACD crossover exit probably is not that effective or powerful, but still when you observe this MACD crossover exit, the table alone, it still gives you a positive returns, means that it gives you a positive return expectancy. And they will argue that probably this edge, the underlying power or the edge advantage for this technique lies on the MACD crossover entry. And therefore, we need to run for the second experiment, which is going to be very much different from the first experiment in terms of the entry. So we make two comparisons of the strategies in the second experiment, which on the first strategy, we just make random buying and random selling compared to the strategy with MACD crossover entry and exits. Then we try to compare these two performances, then we can have the unbiased evaluation of whether the entry has the advantage or not for the traders. So to evaluate or to simulate this trading technique to buy or to sell the stocks at the random time, we can just simply buy the stock at every single day. It means that our portfolio just need to buy the stock at every single trading day, and then we try to exit at different exit days. And for this experiment, we just need to limit to 10, 20, 30, and 40 days exits, just to make a fair comparison later on with the first experiment. And then once we have the outcome of the performance, we just simply need to average it out. And to make this experiment unbiased, well, we just need to test across the US largest 500 stocks, and we do it across 14 years. Once we have this performance table, we just need to make a comparison between these two strategies. So the one with the random entry and exits, compare it to the strategy with the MACD crossover entry and exits. Let's take a look at this page, and let's focus first on the exit 10 days later. Well, in this page, I present you based on two strategies. The first strategy based on the random entry, and the second strategy based on the MACD crossover entry. Now, let me just explain to you about a little bit about the random entry here, especially on how we purchase the stocks. Well, as you can look at the table here, it's referring to the performance of each year. So how we make the entry here is that we just make the trade, or we buy the stock every single day. Day 1, day 2, day 3, day 4, day 5, day 6. So we buy the stocks every day, and then we try to sell them off 10 days later. So when you buy at day 1, you sell it at day 11. When you buy at the day 2, you sell it at the day 12, and so on. So practically you make it every single day you buy the stocks. Whereas for the MACD crossover entries, I think it's pretty much obvious. It's very obvious here. The entry was just based on when there's an opportunity, when the MACD line cross over this, the signal line means that when there is an MACD crossover happens, then we buy the stocks. And then once we buy the stocks, we just exit it 10 days later. So this technique or this approach applies to the other table as well. For example, for the exit 20 days later, same thing applies here for the random entry. We just buy the stock every day on every single trading day, and then we exit it 20 days later. Now let's take a look at the performance. Based on the random entry and we exit 10 days later, apparently that the average return per transaction gives us about 0.69% with the average winning rate 56.83%. Well, now if you do compare, if you make the entry based on the MACD crossover, you realize that the average return per transaction is almost the same. One is 0.69, one is 0.70. It's kind of like insignificant, I would say. And talking about the average winning rate, well, the MACD crossover is giving 57.04, and it's very close with the random entry. So this tells you that when you make a random entry and random exits, or 10 days later, right, then your average winning rate is 56%, 56.83% compared with the MACD crossover. Then you exit 10 days later, which is 57.04%. So when you're comparing these two performance, I would say there's a slight difference, almost insignificant, or I can conclude it that these two tables are kind of giving the same or similar performance. Now let's take a look at the when you exit 20 days later. With the random entry, your average return per transaction is about 1.38%, and your MACD crossover entry is 1.41%. And then the winning rate with a random entry is 58.69%, and the MACD crossover entry is 59.06%. And again, it's very close to the first table of exiting 10 days later. Apparently, when you exit 20 days later, that your entry does not make any much difference here, whether you make it random or using MACD crossover to enter or to buy the stocks. Does not really give you much difference, kind of like insignificance. Now let's take a look when you exit 30 days later. Well, apparently this is slightly higher, but I would say insignificant as well. Is about the same. The random entry is giving you 2.08%, whereas for the MACD crossover entry, average return per transaction is giving you 1.99%. The average winning rate, both are giving 60%. And for the exiting 40 days, well, they are just about the same. Well, from this table, can you see, or can you conclude that there is not much difference when your entry is using a random or just using the MACD crossover? Well, we know that for the exits, it does not make any much difference. But when you know that when you exit with the longer days, it tends to give you better performance. But I would say that in general, that when you make a random exit or MACD crossover exit, the performance is just about the same. So MACD crossover exit does not give you much advantage for the traders to exit your positions. But with this experiment 2, it signifies the point that MACD crossover entry does not give you advantage as well for the traders to buy or to purchase the stocks. Because, well, when you buy it at a random time or using MACD crossover to buy the stocks, it does not make difference in terms of the average return per transactions, and also does not make difference in terms of your average winning rates. So, or if there's a slight difference, I would say it's a very insignificant difference here. Now, you see my point that by using the MACD crossover technique to buy or to sell stocks, it looks profitable at first until you run some experiments with some data which you see yourself. Then you start to realize that this MACD crossover technique apparently is no better than just any random strategy that buys stocks at a random time and selling it at random time as well. And I would say the problem comes when, since this strategy is very popular and widely used by many professionals and traders, it kind of giving you a confidence or convince you to buy more when you see a crossover entry opportunity, or you start to be panicked when you see a crossover exits. And when you start to put your emotions into your trade, when you see this entry opportunity or the exit opportunity, many times traders start to overweight their positions, which tend to cause a big profits, or it can wipe out their capital just in a day or a couple of days. So just be careful when you trade yourself in the stock markets at all times. And that's all I have for now. I hope that the information, some proprietary information and data that I shared with you, going to be helpful in a way to make you a better traders. And till then, I will see you in the next one.